Hello, I'm Stephen from TEFAT, and tonight I'd like to give a presentation on sales returns, purchase returns, also discount allowed and discount received in bookkeeping. I was going to include this in one on the profit and loss statement, but I realised there was so much content this really had to be a separate presentation. So with sales return, this is a credit sale, so the sale is going through accounts receivable, also called creditors. The following double entry bookkeeping in General Journal has to be done initially for the initial sale. So you might have seen this before. It's debit, not that one. I didn't write one, but I'll verbally say it. That you debit accounts receivable and you credit sales. Debit accounts receivable, credit sales, okay? And the sale is a credit sale, not a cash sale. So if you've got a sale return, there's a problem. In broad terms, you've got this account called sales return you've got to introduce as a T-shaped ledger in the General Journal. And so with a sales return, you have to reduce the accounts receivable, which is an asset. You reduce the accounts receivable account and current assets. An example, Gamma Bikes sell a mountain bike to Townsville Bikes for $100 on credit. Townsville later returns the bike to Gamma Bikes due to the quality being not much better than a discount store bike. The initial sale would be as follows in General Journal. This is consistent with what we've seen. Debits accounts receivable, credit the sale, $100. Remember, it's a credit sale, so it's run through the creditor's account. So also you've got to change inventory. You debit the COGS, cost of goods sold rather. And you credit inventory, $100. Reduce the inventory because it's taken off the shelf of Gamma Books. This is Gamma Books, Gamma Bikes rather, books, not Townsville Bikes. So their inventory is been reduced by a bike. So this is the entry now for the actual sales return, okay? On March the 31st, 2020, we debit the sales return by 100 and we credit accounts receivable. That credit accounts receivables, we reduce accounts receivables because normally accounts receivables has got a debit item, so if you reduce it, you're crediting the accounts receivables. And the sales return from Townsville Bikes was originally sold as a credit sale. This credit of accounts receivable is favourable for Townsville Bikes. And now what I'm trying to say here is that Townsville Bikes don't mind that credit if there's a credit in the accounts receivable account in their account, because that's more favourable for next time, for the next purchase. So these two companies interact together. They've got what you call contra accounts. So either side of the telephone line, there's the accounts payable person interacting with accounts receivable in the other company. Conversely, the accounts receivable person interacts with the account payable. So that's contra. And another definition of contra is barter, but in this context, that's what contra account means, interacting between the accounts receivable people and the accounts payable people. So what happens after the sales return? The bike goes back to Gamma Bikes, so they have to increase their inventory by a bike, and you credit COGS. That's the inventory transaction. And And also that sales return affects the income statement at the end of the period, in the reporting period. The sales return lowers sales, which is revenue or income, so it has to reduce sales. So eventually that sales return can't just stay in the books. It's got to be absorbed into sales by lowering the sales figure in the profit and loss statement. But if the bike had been sold by cash, not credit, not a credit sale, the following general journal entries would apply below. The customer, Townsville Bikes, can choose if they want a favourable debit in their accounts payable account or the cold hard cash. Perhaps they are viewing getting a bike from a different supplier, going long term and getting away from Gamma Bikes a bit, so they just want the cash and continue with their business. I can't keep making general journal entries or I'm going to do my head in. Also, Company A and Company B could have contra accounts between each other again when the accounts receivable and accounts payable departments interact. But if Company A may decide to lend goods to Company C, another company who has never sold a credit item to Company A, does this sound confusing? All I'm trying to say is there is a lot of different possibilities. Sometimes Company C would like a receivables type transaction when they've never even dealt with them before, but they're so big and substantial in the market that you wouldn't refuse, because they could go elsewhere and it could cost a lot of transactions in the account. So a big company like corporation like Bayer Chemicals, if they wanted a credit sale and you've never dealt with them before, you just give it to them, because it could cost you business later. So sorry, I might have what I was getting to back here was I was just going to wasn't I going to outline some cash sale returns? Yeah, that's correct. I didn't quite get to that. I got sidetracked a bit with contra and different algorithms and collections and payments. But this is the sales return for a cash sale. The following double entry must be made. The initial sale, which is what you might be familiar with in a cash sale, you just debit cash, more cash in from the sale, and credit sales. Credit sales is a credit item on the P&L. So the money has been passed to from Townsville Bikes back to Gamma, and the Gamma has sold the bike to Townsville Bikes. But there's a sales return. There's a problem with this bike. The quality of it isn't very good. Not much better than discount store standard in this example. So if there's a sales return later on March the 31st, you debit sales return $100 and credit cash. Because you're paying back money to that Townsville Bikes, you've got to reduce your cash, your current asset, your bank in your current assets, so it's outgoing cash. Debit sales return. With inventory, the bike goes back to Gamma, so inventory increases debit and your credit COGS, 100, which is the corresponding credit. Okay, that's sales returns. Now we're going to cover purchase returns. Purchase return when an item is bought on credit through the accounts payable. Let me define accounts payable. Firstly, let's just clarify that accounts receivable is our loan to other companies for our goods, but our accounts payable is a debt that we've got to other companies, okay? Whether it's the electricity company or whichever companies you deal with, we owe those other companies out there in the marketplace accounts payable. So we're focusing on purchase returns. We're returning. We're asking for some. We're asking to return something so we can have our money back. Now, the original purchase is debit sorry, that's not the original purchase. The original general journal transaction is debit purchases, credit accounts payable. Accounts payable is a credit item. It's a current liability realised within a 12-month period. And you debit purchases because purchase is in COGS. It's a type of expense. So you debit the expense, okay? Now, oh, there no, that's not original purchase. I'll have to delete that. This is the purchase return. So you debit the purchase return and you credit the purchase in general terms. Gamma Bikes wants to return some purchased gear cogs from Hoso bike gears in Japan for $3,000. They are coated with the wrong paint, they say. So the original purchase, now I've got original purchase, it's debit purchases, inventory, and credit accounts payable for $3,000. That was the original transaction. But the company, which is, we said Gamma Bikes, again, they want to return those bikes from Hoso in Japan because of the wrong spray paint. So what happens with a purchase return? Put the date in. You debit accounts payable. Accounts payable is usually a credit item, but if you reduce it, you debit it, okay? $3,000. And you credit purchase return, okay? $3,000. And or if you don't want to create a purchase return ledger, you can just directly credit inventory. If you're not opting to set up a purchase return account. So it's debit accounts payable, reduce that, and credit either purchase return or credit inventory if you don't want to set up a purchase return account. So you reduce the accounts payable after the purchase return in the explanation. And the company hasn't paid for the goods just yet, but they still want the purchase return. At the end of the period, any purchase return has to be reversed, absorbed back into purchases by reducing it. Any purchase return can't be allowed to go into the next period. It has to be reduced to zero, ready for the next period. And also, I'm just writing the example again. If they don't want to opt to set up a purchase return account, debit accounts payable $3,000, credit inventory. The stock goes back to the supplier. And I'm talking about a perpetual inventory system where the computer counts the stock, not periodic, where you manually count the stock. Eventually, the company will receive cash, even though the original transaction was a credit transaction. The cash eventually turns up, even in a credit transaction, or the company could just opt to have a favourable debit in their accounts payable account rather than the cash. If they do want the cash, the following general journal entry is required. Perhaps the company is considering a different supplier. You debit bank, so you get your money back. You credit inventory. You've returned that good. Okay. purchase return when the item is originally purchased by the company as a cash purchase. So this is a cash purchase. Your debit purchases again, $3,000. That's an expense. That's a debit. You credit bank. You've paid cash going out of the company, and that's the original transaction. The bike gear parts bought from Jose for cash, three grand. But there's a problem after the purchase return. You debit bank, you get your money back, and you credit purchase return, $3,000 as well. All right. Now I'm going to focus on both discount allowed and discount receivable. We'll start with discount allowed. Discount allowed is when you give your customer a discount. It's treated as a type of expense because you don't get the full money in the sale. And don't get confused with sales return, purchase return. This is a completely different concept now, discount allowed and discount received. So discount allowed, you're allowing discounts to your customers. It reduces revenue, but if it wasn't given, then the seller would get more revenue. But in saying that, they might lose a bit of revenue, but they might value the quick payment. And in the money market, the finance market, you've got an opportunity cost between investments, and you might get a more favourable investment if you get the money early, okay? Which outweighs what you've lost in revenue. Discount allowed can be given as a cash discount on the spot. Some retailers even offer cash back by giving physical cash back when you buy something, or a trade discount, such as Bunnings Trades, giving a tradesman a discount in their hardware account, so the discount is just applied within the account. A basic transaction for a credit sale is debit the accounts receivable, which makes sense because accounts receivable is a current asset on the balance sheet, so you debit it, and you credit sales. Sales is on the income statement and always a credit item. That's when no discount allowed is offered. However, perhaps the company has hired a sharp new finance manager who on his first day says, "What? You have no discount allowed to your customers?" He hits the ground running and on day one offers a discount to his new customers on the following terms: 2/10 and 30. Now let's just unpack that term in finance. The 2/10 means you get a 2% discount if you pay in 10 days. And the N30, but after 10 days you don't get a discount. But the N30 means the account has to be settled in 30 days, regardless of the discount. Otherwise, you might be charged interest or a late payment fee. So again, and there's different discounts. This example is just 2/10 N30, but if it was 5%, that 2 would be 5. If it was within 20 days, that number would be 20. And if it was had to be paid in 60 days, then that number there would be 60. So they've got a bright new finance manager in. Now, if the company doesn't opt for the discount, then the collection on the accounts receivable account just goes ahead by debiting cash. This is when the accounts receivable is settled by your customers, and crediting, reducing accounts receivable, where no discount allowed is part of it just there. So that's the general journal transaction without the discount. However, if the customer does take the new discount offered by the finance manager, the collection is done along the following lines. First, find the 2% of 500 because the customer pays on day 3 well before the 10-day window. So 2% of 500 is $10. Now the company has to pay $490, which doesn't sound like much of a discount at first, but it could add up over time. The general journal entries for collection in the accounts receivable account on the revised terms are debit bank $490, the amount your customer paid you, and also debit $10 discount allowed. Now, discount allowed is a type of expense which is consistent because the expense is a debit item. But on the credit side, you credit accounts receivable, reduce it by 500. So that 490 plus 10 on the debit side adds up to 500 on the credit side. Okay, so you kind of, with these, you're splitting it in two, like on the credit side there's only one, but on the debit side it's the amount of 500 is split between two items, both discount allowed and also the other one, which is bank, yeah. The incoming cash when the accounts receivable account is settled. So debits still equal credits, okay? Even though on one side of the transaction it's been split into two. Now discount received. What is discount received? It's when you get a discount, your company, from your suppliers out there in the market. And that discount received is treated as your income, which is added to revenue in the profit and loss statement. Company A offers Company B a flat rate discount of $50 if the account is paid in 7 days or less. An extension is granted to the next working day if day 7 falls on a weekend or a public holiday. There is an impending purchase of $700 of electrical equipment on September the 7th, 2021. But on September the 21st, they opt to settle this account. So they take a bit of a loan for a short period within a month. If the Company B opts not to take an early payment discount, then the payment of their accounts payable account is as follows. Now you've got to remember that this is from your company point of view. From Company B, that's their books. Company B will write up the following general journal entry in their books pertaining to the accounts payable. Now this is the original transaction on September the 7th. Debit purchase is 700, credit accounts payable 700. Electrical equipment bought on credit. Now on later in the month they settle, so you debit accounts payable, which is reducing it because it's usually a credit item and the current liabilities, and you credit bank $700 because you've got to pay money to your supplier to settle the account. That's outgoing cash. The accounts payable is settled in full, but the discount offered is not taken in that circumstance. However, in a different scenario, Rick, the accounts payable guy, says to the manager, hey, Company A is offering us $50 discount received. Why don't we take it, the early payment discount, and donate to a local hospital who has an appeal for urgently requiring COVID-19 pandemic protection equipment? So some social responsibility by the company, which is favourable for public relations too. Then in subsequent months we could make future donations while the pandemic lasts. So the general journal entries are now in the accounts payment. Something else added in, which is discount received. Now that's the date in September that they opt for early payment. It's in a reduced time within the discount time frame, and you debit reduce accounts payable $700, but on the credit side, now you pay $650 with a $50 discount, and you get $50 discount received, which is a type of income. So that's on the credit side, because income is a credit item on the P&L statement. Okay. So in this example, you split the credit side two ways, and the debit side has just got the one part of the transaction. So that's the end of the presentation. I hope you found this useful. There is some flexibility even in generally accepted accounting principles. Some companies opt to write their books slightly different, which is within the accounting rules. It just depends how the accountant opts to which accounts to choose. So you might see slight variation in the literature but there are slight differences. That's all I'm saying. So Stephen from TEFAT in Sydney, thank you for watching. Bye.